Hi, everybody, and welcome to our Resources Unearthed and Executive Strategies webinar on executive share scheme vesting. Today's webinar is about what you need to know to accumulate wealth and avoid paying more tax than you should. I'm James Marshall, financial planner at Stratus Financial Group, co-founder of Executive Strategies and contributor to Resources Unearthed.
And I'm Craig Barry. I'm a director at William Buck, and I'm also a contributor to Resources Unearthed.
Before we start the webinar today, just a general advice disclaimer. The webinar that we're working through today doesn't take into account any of your personal objectives, so do take that in mind and seek advice specific to your circumstances. On today's agenda, we'll be going through a number of areas. We'll start off by talking about different types of awards. We'll talk through tax implications, work through strategy considerations, go through a bit of a summary, and then talk about next steps. So kicking things off and talking about types of awards, executives with share schemes, they might have one or more of a range of awards, and they could be awards which are shares, they could be awards which are rights, they could be awards which are options. If you're an executive, you might have all of those, you might have some of those, or you might have one of those. But that is essentially the range of awards which we see executives have. And just to start off, one of the key things we will be talking about, particularly when it comes to tax implications, we'll be referring to a comment around the vesting and what vesting means. And vesting period is a period of time after which the executive award is then available to be transacted on. And we often see vesting periods vary from company to company and award to award. If you're looking at a longer term award, we traditionally see a vesting period of somewhere between 3 and 5 years. Some of the shorter term awards might be a period of 12 months. Again, it does vary company to company and does vary award to award. So as an executive, you might have awards with different vesting timeframes in existence. When we work through the presentation today, it's been prepared on assuming that the award is a grant of shares. Different rules and different approaches apply if you do have an award which are rights or options. Moving on to tax implications. This is one of the biggest questions that we get from our clients around what does the tax position look like? What does it mean? And is there anything that they can do to reduce or help manage their tax? And I'll pass across to Craig to talk a bit about this slide.
So the most challenging part of dealing with ESS arrangements with clients is, especially where it's like a first year that a client's been subjected to the rules, is that surprise, that sort of first year of I've received these shares, I've worked so hard in the last couple of years, the company's done really well, the share price is up, I've received these shares, and now you're saying I've got this enormous tax bill, how is that fair? How is that right? What's going on? So I guess from our perspective, where we do have clients that are engaged in an ESS scheme, that we do try and make it clear to them that when the scheme does vest in their favour, that there will be potentially a tax liability that they will need to fund. And then the discussion becomes less around the surprise and the disappointment of having this tax to pay, and more around strategy of how to manage the payment and how best to utilise the money that they receive net of tax effectively.
I think one of the things to just raise with tax legislation in Australia around executive share schemes is that in Australia, there is no requirement for shares to be sold by a scheme administrator at the point of vesting. But commonly we see in some other tax jurisdictions around the world that there is a requirement for shares which the administrator automatically sells to cover tax. Yep. We don't have that in Australia. Yeah, like a withholding arrangement. Yeah. We don't have that in Australia, so you end up with that an unfunded tax liability, which, as Craig has mentioned, is usually an unpleasant surprise, particularly in the first year that it occurs. And then there's a whole range of rules depending on when awards are granted as to what the tax implications are. There's pre-2009 rules. We had the option of being taxed up front or being taxed at the point of vesting, which is the deferred taxing point. There was an interim period between 2009 and 2015. And then there's also rules for awards granted after 2015 as well. So it's important in the context of understanding what the tax rules are today, but also understanding if you do have shares from an executive share scheme that you still retain. It's important to understand what the historical tax legislation was at the point of grant and vest, so you are able to understand what the cost base of those shares are in terms of if there is a consideration around potentially changing the ownership of those shares or selling those shares. You've got to be in an informed position to understand what the cost base of those are.
Correct. And I guess leading into, I think, a later slide, being really diligent about collecting the information that you have around your employee share schemes. So quite often, James and I come up into situations where a client will come to us to say, I've got a lot of shares in my employer company, and they're quite lucrative. They have a lot of value associated with them. I'd like to sell them down. I'm looking at retiring, looking at paying out my home loan. Kids are going to uni, whatever the case is. What's it going to cost me in tax? And often the first question is, well, what's the situation? What's the background? Do you have a cost base? Anything like that? And particularly where you have a client who's been with their employer for, quite a long time. And as you can see here, these rules go back to pre-09. These rules go back decades, to tell you the truth, but these are the ones that are probably most relevant to us today. Being able to reconstruct that cost base is an extremely time-consuming exercise where we are talking about many years, and particularly if you are a reasonably senior executive, you might be involved in 2, 3, 4 schemes each year or at a time. Then reconstructing this cost base can be quite time-consuming. Especially when we need to understand, was it an upfront tax scheme? Was it a deferred tax scheme? Was it one tax at vesting, one tax at exercise, those sorts of things. So as much as a client is able to collect, really makes our job a lot easier and potentially makes your cost a lot less as well in terms of reconstructing.
Yeah, and that could be in the form of digital or paper-based records. Often what we see as well is over the course of a company's life, the actual administrator of the scheme may change as well. So we see that it seems to happen every number of years. There is a change in the actual administrator of the scheme. And often what happens is when you move across to the new scheme, there is information that is not brought across, whether it be the actual records around letters that were generated or whether it's transaction records. And it does make that reconstruction more time consuming and more complicated. But just coming back to that piece around make sure you maintain good records when it comes to things when they're granted, vested, all the transaction information. It does make the job a lot easier, particularly when reconstructing things that happened a long time ago. As mentioned, it's often a surprise when the first vesting of shares turns up, and it's often a surprise that you might not find out for some time after the vesting actually occurred. So as a bit of an example, let's say, for example, you had some shares that were granted to you and they vested, let's say, in August. They would not be captured in your tax return until 30 June in the following calendar year. So if there was a vesting of shares in this month, August 2023, they wouldn't be included in your tax return until 30 June 2024. And if you're lodging with a tax agent, so you're preparing your tax return through an accountant, you might not have a lodgement timeframe until maybe April or so in 2025, which is almost 2 years or so after the vesting actually occurred. You're getting pretty close to 2 years. So to find out, almost 2 years later that there's a tax bill due can be a bit of a surprise. Particularly because there may have also been another vesting in that time period. And depending on how you've managed your share scheme, you may or may not actually have the cash available to fund those tax bills. And an unideal position is that part B that I've mentioned, which is if you're sitting there 2 years later and there's been a decline in the company share price, and you're then looking at funding some potentially significant tax bills, that is something to be aware of as well.
Yeah, and interestingly, I mean, I'll show my age here, but I was advising on some of these things during the GFC back in 08, 09 period. We see exactly that. I remember one poor unfortunate client who worked at one of the banks, and his shares vested at a certain price, and then when it came time to actually lodge his return, his share price actually halved, and so effectively he had to sell all of his shares to pay his tax, which that can be quite a difficult conversation to have, but equally comes around sort of good management, good strategy. So I guess that's part of where this conversation is going to go, is around, well, how do we better manage and strategize with these sorts of situations. In terms of administration and whatnot, the administrator of the scheme will provide the participants with an ESS statement at the end of each year, which is separate to like your employment statement or anything like that, and that will outline the taxable amounts that the company has calculated that you should be taxed on and include in your tax return for that particular financial year. The amounts that are included on that statement also provided to the ATO, and if any of you currently use a tax agent, you might be aware of what a refill report is, which is basically a report that accountants can get from the ATO, which outlines the information that's already been disclosed to the ATO on your behalf, and that would typically include your ESS income. Certainly, the amount that's disclosed may not necessarily be 100% accurate, and so it is certainly well worthwhile having the amounts reviewed, for example, around ESS amounts, particularly where maybe you might be looking at getting the amounts calculated in maybe a slightly different way to what the company's done. There's a little bit of wiggle room there, but certainly where you are planning on deviating from the ATO's amount, you'll need to have pretty good records to support the amount. So there's an example there in terms of, that's around the 30 days rule. So typically with your shares, when they vest, you'll be taxed on that value on vesting day. I think it's based on an average weekly.
Usually it's a volume weighted average, the 5 days before. Yeah.
But if you do sell it within those 30 days, they'll just do it based on proceeds rather than that volume weighted average. So that's what that example there talks about.
And I'd probably just say on that example, often what we have seen, particularly when we're doing a reconstruction or we're looking at reconciliation between documents from the share scheme administrator and tax returns, often if there has been a transaction within 30 days of vesting, it's quite common for us to see that the actual vesting amount has been included on the tax return rather than the actual proceeds, if the sale occurred within 30 days. And that's generally because the administrator, while they keep the records, it's difficult or sometimes impossible for them to actually reconcile what transactions actually link back to the vesting which just occurred.
Yeah, especially if you have like multiple transfers of shares, and
yeah,
it might be difficult to pinpoint those shares to those particular, or those sales to those particular shares.
Yeah,
absolutely.
Yeah, and often they form part of the a vested share pool.
Yep.
So there's a pool of shares there that the administrator doesn't know specifically what parcels you've sold often.
Right.
And then just that example that we have at the end of the slide here is just talking about, as an example, if you had shares that vested and they vested at a value of $100,000, but you sold them within 30 days for $105,000, the correct way generally for that to be on the tax return is to show an amount of $105,000, not the 100. But yeah, that's the piece, just to make sure those pieces all match up and aligned to the tax rules.
And where that can be important is around the tax treatment of those amounts. So the ESS amount that you get assessed on is just straight assessable income. So you get taxed dollar for dollar on that. And obviously you can apply deductions to some extent to those potentially. Whereas if the amount that you receive, for example, is outside the 30 days, the difference, so in this example, $5,000 might be a capital gain or capital loss. And where that can be relevant is, for example, if you had capital losses carried forward, and the proceeds are now $5,000 more, potentially that extra $5,000 might be able to be not taxed if you've got capital losses to offset against that. Whereas if you sold it within the 30 days, unfortunately you wouldn't be able to apply capital losses because you're unable to offset capital losses against income.
Excellent. The other piece as well, we talked about what happens when you get that first surprise tax bill when your return's lodged. When that happens as well, it can often push you into a quarterly installment system as well, which can be an additional surprise. Craig will provide a bit more context around this example, but following on from the example earlier, if you had a vesting in August 2023, let's say that resulted in a tax bill of $40,000 for the 30 June 24 financial year, that might not be payable till April 2025. But when you get to April 2025, you could actually be in a position where not only do you have the $40,000 of tax to pay, but you also have quarterly installments. And due to the fact that you would be 3 quarters through the new financial year, you might also be facing quarterly installments of $30,000 to top you up to give you a total tax bill of about $70,000.
And I guess it's important to note there that the quarterly installment arrangement, that catch-up, which James mentions, only really applies if you're already in the quarterly installment system. So, for example, hypothetically, if you'd previously been paying some small nominal quarterly installment amount, so let's say you had a small share portfolio or a term deposit or something like that, where it was triggering a small tax installment, then hypothetically, if you're paying say $1,000 a quarter on that small investment that you had, and then you triggered that $40,000 tax bill, then that's where potentially you might get into a large, basically like a double tax bill of that $70,000. And I mean, it could actually be worse because obviously James is talking here about lodging pre-April. But if you were to lodge in this example post-April, you might actually have the full 2 years worth of tax you might have to pay at the one time or over, within 6 weeks or so of each other. And that can be difficult to fund, especially again if it's a surprise and maybe you spent the money, or maybe the money's tied up in investments, or maybe like James mentioned before, if the investment value is reduced dramatically, then it might be quite a difficult strategy to try and pull together. So just with installments, so managing the installments tends to be like a quite a personal client by client conversation. So the ATO has 2 different methods for managing quarterly PAYG installments, and that's using the installment method or the rate method. The installment rate method is sort of the default method. So typically, if you're new to the system, the ATO will generally push you into the installment method if you don't make a choice. And typically, the installment method is really just saying, for example, using those figures above, you had a $40,000 tax bill, divided by 4, that's $1,000 a quarter, quite straightforward. But bearing in mind that, and installments don't apply only to ESS income, they apply to all sorts of investment and business income, effectively untaxed income where it applies. The rate method may also be relevant, particularly where the income is sort of not even throughout the year. So it may be the case that maybe the income is more concentrated towards certain parts of the year, which might mean that you might pay higher installments in certain parts of the year than others. Now, where this becomes interesting, and I don't know if we want to go into huge amounts of detail around this, but ESS income technically isn't considered to be installment income, which means that we've got a little bit of leverage when we talk about using the rate method. So if we were to use the rate method, so the types of income that you apply against your rate, which the ATO will provide to you, which is a percentage, which is like an analog for your personal marginal rate, you would apply your gross investment and business income against that rate. Now, if your only income that might fall into that category is your ESS income, then you're actually allowed to not include your ESS income because it's actually not installment income, which might mean that your installment amounts are actually nil or very low, which from a cash flow deferment point of view could be a good strategy. But what that also means is that you're basically kicking the can down the road until you're actually lodging the return and generating that tax bill. So like I mentioned before, it's really a client by client situation. So that's where Do you know what's happening there?
No. Let's just wait and see. Should be back.
We're back.
Apologies.
Sorry about that. We seem to have lost connection for a second there. So just to close that off, what I was saying was that the choice out of those two methods really comes down to client by client discussion and to work out what their preference is. So for clients that are happier to spread the cash flow across a financial year to fund the tax on that ESS income, then the instalment method might be the preferred. Whereas for clients who would prefer to keep that money in their own pocket until the latest possible moment, then the rate method might be the preference. So that's a choice you can make. Unfortunately, the choice is set for a financial year. So September tends to be when that first choice is able to be made. Obviously, if you're new to the system, it's when you get that first notice for the year. But for ongoing participants in the system, your September instalment notice will be when you make that choice, and then that choice is then set for the remainder of that year. So unfortunately, we do see a couple of clients who come through the door who have already been paying instalments under the instalment method, and then they might have then a big tax bill from ESS income. Unfortunately, there's not a lot we can do to try and manage that down. That's sort of a different conversation to have at that point.
Yeah, and I think the context is there's different ways to do it, but it's understanding what that means for you specifically in terms of when you're expecting installments to be paid, whether it's a high amount that's paid through the year or whether it's a lump sum amount. But being in that fully informed position to understand what that does look like, I think is key.
Yep.
The other piece on tax implications are international assignments, or where you have either left Australia not on assignment, but you might have accepted a permanent role overseas, or you've either returned to Australia or you've come to Australia for the first time. There are significant other levels of complexity on all tax affairs, but also executive share schemes. And that includes things like foreign income tax obligations and also obligations in Australia as well. So just because you leave Australia doesn't mean that your obligation for tax payable on executive share schemes disappears. There are still obligations here that you need to be aware of. There's also that piece, as mentioned earlier, around foreign tax jurisdictions having different rules. Some of them may require a withholding at the point of vesting, which may result in the forced sale of shares at that point in time. There's also the interaction of company tax equalisation policies. Not all companies have these, but some do. That creates even a further layer of complexity, and that is one element where we have seen some, issues when it comes to executive share schemes around amounts potentially being incorrectly withheld from clients when it comes to their share scheme, and then going through a process of having that remediated back to the clients has taken a long time to identify and then also recover. So we've done a few of these together, kind of referring to recent experience from point of identification and raising it with the company up to the point of recovery is usually about 12 months on the few that we've looked at. It does take a significant amount of time to communicate to the company and find the right person there to have things resolved and then it all washed through the appropriate advisors that the company uses. So there are additional layers of complexity there. There is, as mentioned, the company tax equalisation policy. And then when we do have foreign tax jurisdictions, often they do not run the same tax year as Australia. So there's a mismatch often in payments and timing of when tax is payable in Australia and foreign jurisdictions. And what that looks like from a lodgement perspective, and then also crediting foreign
might also
foreign
be a
taxes as well.
mismatch in terms of when they consider ESS items to trigger income and when Australia does.
Yep.
And that can also cause some issues as well. So it's really like if you are dealing cross-border on ESS type income, you really do need to get an advisor to help you because there's a lot at stake and a lot at play.
Yeah. Excellent. Is there anything extra you wanted to add on the international assignment piece?
I think the only point I'd probably add, and it's not really adding too much, but just that those tax equalisation policies there's no one size fits all. They're all different. Each company, to the extent they have a policy, they're all different, and some are quite advantageous. Some are more trying to be neutral, I guess is the best description. So I guess part of the arrangement, if you are sort of tapped on the shoulder to go on a secondment, part of your due diligence would be around understanding that tax equalisation process, if there indeed is one, and understanding what that means to you, and when you might have to make payments back to the company, or when the company might have to make payments to you for certain types of arrangements.
Yeah, excellent. And then moving on to strategic considerations. So this is talking about, when a vesting occurs, what are some of the options available to you as an executive? There's a whole range of them. What is right for you depends on a lot of things, but it is very personalised as to what the right approach is, and it often requires a broader understanding of what your position actually looks like, so broader than just the share scheme piece. But options include when something does vest to you, well, you could retain the vested shares that turn up. You might consider, well, if you are retaining them, where do you best hold them? Whether it's in your personal name, it might be in the name of a spouse, could potentially be a contribution to a super fund, or it could be through some other structure, a company or a family trust potentially. And then if you do retain vested shares, just casting our minds back to the tax implications at vesting, there will be a tax bill which will need to be funded. So that would need to be funded from somewhere in that particular consideration. You could also consider selling enough shares to cover the future tax liability that's coming. So the tax liability due for the end of the year, plus potentially installments as well. And just a reminder again, that first bullet point there around the Australian tax legislation doesn't require shares to be sold at vesting to cover tax. So to keep that in mind, you're effectively kind of creating that arrangement yourself.
Yeah, and effectively you're like creating a hedge at that stage. So if you are looking at selling at the time of vesting, effectively what you're saying is, well, you're prepared to make sure you've got that money put aside to fund your tax when it falls due in 12, 18, 24 months, which is good. It means that you're prepared and you're taking the risk off the table in that regard. I guess on the flip side also it means that you are also, I guess, not accepting any upside on potential growth in the value of those shares, and that's really going to come down to your and your advisor's view on those particular shares, and may well be that you're prepared to take the risk that the shares will lose value in order to take any upside in the event that they go up. But equally, you might say, well, particularly if you're in a company that might be quite have quite significant movements in value over a 12 or 24 month period, you might say, well, I'm not prepared to take that risk. I'll take that off the table and just convert it to cash.
Yep. And then the final option is very similar to that as well, except considering selling all of the shares potentially. Again, depends on broader circumstances, but there might be other uses for it which are more appropriate for you. So it could be using it to effectively reduce debt, or make contributions to super, or invest in something else, or contribute to super. So there's a whole range of options. And following on to the next slide, which is, well, how do you create wealth when it comes to an executive share scheme? They can be worth a lot of dollars, but it's around managing it all the way through to make sure you do understand what the implications are when it comes to the tax side of things, considering it in the broader picture of what your full financial world looks like as well, to help work out, well, what is the right thing, and to consider, the other circumstances which could occur around, well, what happens with share price movement, if there's an interaction of an international assignment, considering that as well. And of course, as mentioned, make sure you keep really good records all the way through to make your life a lot easier when it comes to, being there later on. You might have a big nest egg tied up in it, but if you don't know what the tax implications are of realizing some of that to go towards some of your other lifestyle objectives, that's an expensive position to be in, because you'll need assistance most likely to help rebuild what that picture looks like from history. Moving into a bit of a summary, So key learnings from today, understanding what the taxing point is of your awards. Now, as mentioned, this presentation's been prepared assuming that the awards are shares. There's different rules which apply to rights and options. To make sure and be aware of what tax is payable and when, and to plan accordingly. You don't really want to be caught out for a surprise when tax bills turn up. Seek advice for altering the manner in which your instalments are calculated. That's, as Craig mentioned, can change the way that things look and make things potentially a bit more palatable throughout the year if something happens at a lump at a single point in time. To make the best out of an executive share scheme toward accumulating wealth, consider what you do at each vesting and then what you do with any retained or existing shares as well. So again, presentations mostly about what happens at vesting, but executives often have a large pool of shares, which they might have built up over time from prior vestings. And considering that in the scheme of your overall wealth creation picture is really important. And then finally, as mentioned many times throughout, keeping records all the way through, that really makes the difference when it comes to managing things going forward.
Absolutely.
Yeah.
Do we have any questions?
I'll just check. I'll just pause for a moment and just check to see if we've got any questions which have come through. So please bear with us while we do this. This is just loading, so please bear with us. Haven't been any questions yet. I am just going to check one other section. No questions yet, which is fantastic. Thank you, Gemma. Just in terms of next steps from here, so as a bit of an overview, there are a whole range of services which exist around executive share schemes. There is assistance out there for when you do need it and when you do want it. There's a whole range of things as put up on that slide there. It could be reconstructing a position that you currently have. It could be working through the cost base of what you hold. Having the opportunity to actually have a discussion about your share scheme and what it means in the context of your broader wealth picture, what you do at each vesting, how you manage the tax side of things. All of these things are services which are available to you with the right assistance. And as a bit of a call to action, the next steps for you, there are two websites, Resources Unearthed and Executive Strategies. Please visit those and check out our blog and also the resources that are available. Both of those are information hubs, Resources Unearthed being a hub for those that work in mining and resources, and Executive Strategies for executives in other industries. There are a range of collaborators and contributors there. Craig Barry as the accountant, myself as the financial planner. There's also legal contributors there as well for a broader range of topics. If you do want to have a conversation with Craig or myself following today's presentation, please email us. So contact@resourcesunearthed.com.au and contact@executivestrategies.com.au. We'd be happy to continue our conversations there. Any closing remarks, Craig?
No, I think you've covered it all pretty well. I look forward to hearing from all of you, and any questions you have, we'll be pleased to try and assist you with.
Yeah, brilliant. Thank you, everyone, for your time. And we will look forward to doing another webinar with you in the future. Thanks.
Perfect.